let me touch on trade, which has been a key support to the improving growth performance. As Malaysia is a highly open economy, with trade accounting for more than 100% of GDP, the improvement in the global economy continues to underpin our economic recovery. In the third quarter of 2020, higher demand from key trade partners has resulted in gross exports, rebounding to grow by 4.4% in the third quarter. The recovery in exports performance was driven by higher E&E exports, given strong global demand for work-from-home equipment, servers, and medical equipment. As a result, the current account of the balance of payment registered a higher surplus of 26.1 billion ringgit, or 7.1% of GDP during the quarter. With the reopening of the economy and normalising demand conditions, the labour market has also shown improvements. Employment growth registered a smaller contraction, while the unemployment rate declined, supported by positive rehiring activity. In addition, the placement rate of retrenched workers into new jobs continued to improve in the quarter and into October, amid a decreasing trend in workers applying for jobless claims. The steady improvement in overall labour market conditions, particularly income, provides fundamental support to the recovery in private consumption. This is validated by the latest wages and sales indicator. In addition to income, less stringent mobility restrictions relative to the first half of this year and continued policy assistance are also expected to support household spending going forward. The outlook going forward remains subject to downside risks. In particular, the primary downside risk to global growth is the resurgence of COVID-19 cases, leading to a reintroduction of containment measures. However, the risk to growth from these resurgences is not expected to be as severe as the magnitude of the contractions observed in the second quarter. On the domestic front, this is also a risk to our growth prospects. The targeted containment measures could weigh on economic activity in the affected states. However, the current targeted CMCO is not the same as the previous MCO. Almost all sectors are allowed to operate, while households and businesses are able to adapt quickly to SOPs. Policy response is also gaining traction in supporting the economy. As such, we expect the impact will be less severe than the second quarter. This is also corroborated by several high-frequency indicators which suggest that consumer spending is less affected now compared to the second quarter. I wish to share an interesting statistics. 2 days ago, on 11/11, online transactions in Malaysia hit a record high of 3 million ringgit transactions, well above the normal daily average of about 1 million ringgit transactions. This tells us two things. One, the digital retail revolution is gaining momentum. And two, this also suggests that people are still spending. The impact of the recent CMCOs on 2020 real GDP is about half of the impact of the MCO in the second quarter of 2020. During the CMCO implementation period, the daily impact is estimated to be about 0.3 billion ringgit. Going into 2021, the Malaysian economy is projected to recover and grow within the range of 6.5% to 7.5%. This projection is also in line with other multilateral institutions such as the IMF and the World Bank. Growth in 2021 will be driven by a rebound in global demand. Malaysia's key trading partners are projected to register better growth prospects in 2021. The higher external demand will have positive spillover onto export-oriented industries in the form of higher income and investment activity. Moreover, gradual normalisation in economic activity would promote strengthening in employment and income prospects and support consumer spending. Investment activity is also expected to rebound, supported by strong investment intention, with certain segments and continued implementation of large infrastructure projects. Finally, growth for the next year will be further lifted by higher production from existing and new facilities, particularly in the commodity and E&E subsectors. Several forward-looking indicators are already suggesting firm support for trade and business activity. Industry forecasts suggest that global demand for E&E products to improve significantly in 2021, as reflected by a pickup in new export orders. The continued increase in early-stage construction work suggests a recovery in domestic investment activity. Headline inflation recorded a smaller negative during the quarter, due mainly to the increase in domestic fuel prices. Meanwhile, core inflation moderated slightly to 1%, amid lower rental and accommodation inflation. In line with earlier assessments, headline inflation is likely to average negative this year, given the substantially lower global oil prices. Going forward, headline inflation is expected to average higher in 2021, in line with the recovery in global oil prices. Core inflation would remain subdued amid continued spare capacity in the economy. The inflation trajectory, however, would continue to be determined by global oil and commodity prices.